Imagine it's the hottest day of the year, the sun is blazing, and everyone is looking for a way to cool down. The temperature is soaring, making it the perfect day for a refreshing drink. You've set up Lulu's legendary lemonade stand, a beacon of hope for parched passers-by. You've got your sign, your table, and a whole lot of lemons ready to be squeezed. You invested all your pocket money, every last cent, into making this the best lemonade stand the neighborhood has ever seen. You're counting on this venture to be a success, and business is booming. People are lining up, eager to taste your legendary lemonade. The word has spread, and everyone wants a cup. Coins are clinking into your cash box, a sweet sound of success. Each sale brings you closer to your dreams of lemonade empire. Lemonade is flowing, pitcher after pitcher, quenching the thirst of your ever-growing customer base. You're in your element, serving up smiles and refreshment, until you run out of paper cups. Disaster. You have gallons of lemonade left, enough to satisfy the entire neighborhood, but no way to serve it. Your customers are waiting, but you're helpless. You're stuck, paralyzed by a lack of a simple resource. You're asset-rich, overflowing with delicious lemonade, but can't meet demand. Your potential profit is slipping away with every passing minute. This is liquidity risk in action. A perfect example of how things can go wrong even when you have plenty of product. It's not about being poor, it's not about lacking the core product, it's about not having the right resources, the easily accessible ones, cash or quickly sellable assets, things you can turn into cash fast when you need them. When those customers are standing right in front of you, wallets open, your business grinds to a halt, despite the abundance of lemonade and eager customers. And customers wander off, disappointed and thirsty, seeking refreshment elsewhere. This isn't just a lemonade problem, it's a fundamental business principle. It's what happens to banks and big companies too, on a much larger scale. They might own skyscrapers and billions in assets, vast real estate holdings and investments, but if they can't get cash to pay bills today to meet their immediate obligations, they're in trouble, big trouble. Understanding liquidity risk, grasping this concept, is your first step to financial savvy. It's a crucial element of financial literacy. It's the difference between the critical distinction between owning a treasure chest you can't open, a fortune you can't access, and having the key when you need it, having the means to unlock your resources when the time comes. So, as we dive deeper into the world of finance, as we explore these concepts further, remember the thirsty lemonade stand. Let it be a constant reminder. Liquidity is about being ready for the unexpected, about having a plan for when things don't go as planned. Let's see how this plays out in the real world, in the complex world of business and finance. So, what is liquidity risk? It's the danger that a company or bank can't meet its short-term financial commitments. You might own a car and have a pension, but if your bill is due tomorrow and you have no cash, you have a liquidity problem. Liquidity is about having enough cash or assets you can quickly turn into cash to cover immediate needs. A business can be profitable on paper, but if it can't pay its bills on time, it faces a cash crunch. Liquidity risk is the what-if scenario. What if a big customer pays late or markets freeze? It's different from insolvency, where you owe more than you own. With liquidity risk, you might have plenty of assets, but if they're hard to sell, you can still go under. It's the classic case of being asset-rich but cash-poor. That's why liquidity matters. Liquidity risk, a critical concept in finance, essentially boils down to the ease with which an asset can be converted into cash. It's a multifaceted challenge that can impact individuals, businesses, and even entire financial systems. Liquidity risk comes in two main types. Market liquidity risk, which concerns the ability to sell an asset quickly without significant loss of value, and funding liquidity risk, which focuses on the ability to meet short-term financial obligation as they come due. Market liquidity risk is the danger you can't sell an asset quickly. It's the risk that arises when there's a lack of willing buyers in the market without slashing its price. This can happen for various reasons, such as a sudden shift in market sentiment or a lack of information about the asset. On a hot day, lemonade is easy to sell, but try selling it at midnight in winter. No buyers or only at a loss. The same principle applies to financial assets. In finance, some assets like government bonds are very liquid. They can be bought and sold rapidly with minimal price impact. Others, like property or rare art, are not. These assets may take a long time to sell, and you might have to accept a lower price than you initially hoped for. If you need cash fast, illiquid assets force you into a fire sale. Funding liquidity risk is about meeting your day-to-day obligations, paying bills, salaries, or depositors. It's the risk that you won't have enough cash on hand to cover your immediate liabilities. A bank faces this if too many people withdraw money at once. A bank run. This can quickly deplete a bank's reserves and lead to its collapse. A business faces it if it can't raise cash to pay suppliers or staff. This can result in late payments, damaged relationships, and ultimately business failure. It's the risk of your financial well running dry. Both types can bring down even the biggest institutions. Managing both is crucial for survival. Know the difference and you're already ahead. Let's see why this matters to everyone. Understanding and mitigating these risks is essential for maintaining a stable and prosperous financial future. Liquidity risk isn't just a problem for banks and CEOs, it affects everyone. The financial system's liquidity is like your home's plumbing, invisible until it clogs, then chaos. A liquidity crisis at one big institution can trigger a domino effect across the economy. Banks rely on short-term deposits to fund long-term loans. If everyone withdraws at once, the bank collapses. That's why governments insure deposits to prevent panic. For businesses, a cash crunch can mean bankruptcy, unpaid suppliers, and lost jobs, even if the business is profitable. For individuals, a liquidity crisis can crash markets, shrink pensions, and make loans harder to get. It can lead to recession and job losses. Liquidity risk shapes the stability of our entire economic world. That's why you should care. History is full of companies, big and small, across various industries that learned about liquidity the hard way. Sometimes the lessons are dramatic, even devastating, highlighting the critical importance of managing cash flow effectively. Take Bear Stearns in 2008, a prime example of how quickly things can unravel. They were a Wall Street giant, an institution synonymous with financial power. Bear Stearns boasted billions in assets, a seemingly unassailable fortress of wealth. But the problem was that most of those assets were hard to sell quickly. They were illiquid. When panic hit the markets, fear spread like wildfire. Suddenly, no one would lend them cash. The credit lines dried up, and in a matter of days, they collapsed under the weight of their illiquidity. It wasn't because they were fundamentally worthless. Their assets still held significant value. The issue was that they had no liquidity, no readily available cash to meet their immediate obligations. This forced them into a fire sale merger, a desperate attempt to salvage what they could. The merger happened at a fraction of their former value, a devastating loss for shareholders and employees alike. Now, let's consider Woolworths in the UK, a different kind of cautionary tale. Woolworths was a beloved high street store, a fixture in British life for generations. They had lots of assets, a vast inventory of goods and a recognizable brand. However, they suffered from weak cash flow, struggling to generate enough cash to cover their expenses. Then, when credit markets froze during the global financial crisis, their problems were amplified. Suppliers, fearing for their own financial stability, demanded cash up front for their goods. Woolworths simply couldn't pay. They didn't have the necessary cash reserves. As a result, they couldn't restock their shelves, leading to a downward spiral, and tragically, Woolworths collapsed before Christmas, a devastating blow to the British high street. Both Bear Stearns and Woolworths had plenty of assets, substantial holdings that appeared to guarantee their survival, but they had no cash when it mattered most, when liquidity was the only thing that could save them. Liquidity risk is a real threat that can topple giants, even the most established and seemingly secure companies. It can bring down household names alike, brands that have been trusted and relied upon for years. It's a lesson that every business leader, every entrepreneur, and every investor needs to understand. You're never too big or too loved to fail if you neglect your cash flow and liquidity management, because ultimately, if you can't pay your bills, your long-term prospects are severely compromised. Even a century of goodwill, a legacy of customer loyalty and brand recognition can't save you from a cash crunch, from the devastating effects of illiquidity. Liquidity is survival. It's the lifeblood of any organization. These stories aren't just history lessons from the past, they're stark warnings, reminders of the importance of financial prudence. Always have cash ready, maintain healthy cash reserves to weather any storm. Don't just rely on assets on paper, ensure you have readily available liquid funds. That's the real lesson, the key takeaway from these cautionary tales. Let's see how smart organizations, the ones that thrive and endure, proactively avoid these fates by prioritizing liquidity and sound financial management. How do smart organizations avoid disaster? They actively manage liquidity risk. First, they keep a buffer of highly liquid assets, cash, central bank reserves, top government bonds. These are their emergency funds ready to use at a moment's notice. Next, they diversify funding sources, never relying on just one way to get cash. Banks use a mix of depositors, interbank loans and bonds. Companies use loans, trade credit and commercial paper. Effective cash flow management is key, tracking money in and out, forecasting needs and spotting trouble early. It's like checking the weather before a trip, so you're never caught in a storm unprepared. These strategies keep businesses and banks afloat even when the unexpected hits. Preparation is everything. After the 2008 crisis, regulators created tougher rules to make banks safer. Enter Basel III. Basel III introduced two key safeguards, the Liquidity Coverage Ratio, LCR, and the Net Stable Funding Ratio, NSFR. The LCR requires banks to hold enough liquid assets to survive a 30-day cash crunch. The NSFR ensures banks fund long-term loans with stable long-term money, not just short-term borrowing. These rules force banks to keep bigger liquidity buffers and manage funding more carefully. It's like mandatory seatbelts for banks, adding safety even if it's less convenient. The goal? Prevent one bank's failure from triggering a system-wide panic. These regulations protect you, the consumer, by making the financial system more resilient. They're technical, but their impact is huge. That's how we build a safer financial world. Rules and buffers are great, but banks also need to practice for crises. Enter stress testing. Banks and regulators simulate worst-case scenarios to see how liquidity holds up under pressure. These tests reveal hidden weaknesses, like over-reliance on one funding source or overestimating asset liquidity. The results force banks to fix problems before a real crisis hits. Every good bank also has a contingency funding plan, a step-by-step playbook for emergencies. It outlines who does what, when and how to act fast if liquidity dries up. For businesses, this might mean backup credit lines or supplier agreements. For banks, it's proof they're ready for anything. Planning ahead turns chaos into order. That's how you survive the storm. From lemonade stands to global banks, the lesson is clear. Preparation is everything. Managing liquidity risk isn't about predicting the future. It's about building resilience for the unexpected. Great businesses and stable banks prepare when times are good, not when the storm hits. They build buffers, diversify funding, and stress test their plans. This mindset separates survivors from casualties. The same applies to you. Your emergency fund is your liquidity buffer. Multiple income sources and regular budget reviews are your personal risk management tools. Managing liquidity risk is about empowerment, taking control of your financial destiny. Like carrying an umbrella, you hope you won't need it, but you'll be glad you have it when the rain comes. So always make sure you have enough cups. Be ready for anything.